Over the last few weeks, President Donald Trump has been trying to make good on the promises he made back on the campaign trail, from negotiating NAFTA to putting up tariffs and the wall. Markets have reacted positively to the tough talks, but my guess is it might be time that gold starts to play catch-up. Joining me is Bart Melek, Global Head of Commodity Strategy at TD Securities. Thank you for joining me. Why do you see a case for gold going up, Bart?
Well, I think the market was pricing perfection from Donald Trump, and certainly by the way the first 2 weeks are going, we're not seeing any perfection from the new administration. It certainly looks like in the aftermath of the failure to pass the Obamacare repeal and replace, now there are doubts that the stimulative package that was promised and that would take the form of lower taxes and more infrastructure spending may also be delayed. This means there's less incentive for the central bank in the US to hike rates and limit growth.
Now, what are the dynamics that are happening right now? Because you and I had chatted back at the beginning of the year, and you were pretty bullish on gold. So right now, do you like gold even more than you did then?
Well, we still like it pretty much the same. Our forecast hasn't changed, though we are quite happy that our morose view of the world has materialized, I guess. It has not. We still see, however, gold moving higher. By the end of the year, we're looking at 1275 average for the quarter and probably testing the 1300 level.
So your call previously was 1256, but you're expecting it to go a bit higher.
Yeah, that's the annual average, but the quarterly averages will move up from here on. For this quarter, we're looking at about a 1225 average, which is pretty much where we're trending right now.
Now, on the flip side of that, you say that assuming proposed tax cuts, spending increases, trade deals, and import taxes materialize, it could be bad for gold, but it's good for equities and the US dollar.
Yes. If the Trump administration does give us perfection on the policy side and delivers the robust tax cuts in the form of corporate and consumer cuts on the tax side, that will likely mean higher profitability. It will likely mean more spending. And given the fact that the US economy is already nearing full employment or full capacity, chances are under that scenario, the US Federal Reserve would be somewhat more aggressive in the way it handles the interest rate outlook. It would probably lift rates more, and that means higher dollar and higher opportunity cost of holding gold, which is never good news for a price.
Bart, in your note, you draw on the 1985 Plaza Accord. Is that something you're watching? What is it? Why are you looking at similarities there?
Well, we certainly have looked at the Plaza Accord signed in 1985, and this was essentially an agreement between the United States and its key trading partners to solve the problem of large current account deficits that resulted from poor export activity to the rest of the world as the US dollar surged. This was done under the Reagan administration, an attempt to lower the value of US dollar to restart exports and manufacturing activity in the United States.
At the current situation right now, do you think we could be looking at something similar, Plaza Accord 2.0?
I'm not sure if we're going to get any sort of accord like that. The environment structurally and politically is much different. But certainly that is something the market will be wise to look at and basically to give us an idea how we could see the US economy and the current account situation deteriorate if the US dollar were to surge as, for example, as a response to higher rates if the US economy performs well.
In your note, you also warn that, in terms of the overall tone, if the U.S. acts aggressively, either by depreciating the U.S. dollar or by introducing new taxes, there could be some risks. What do you think the risk could be for the economy, for equities, and even for gold?
Well, first of all, if the U.S. does lower the dollar somehow, that will likely create some sort of an inflation risk. And the very fact that you would have a lower dollar is positive for gold. You add to that an inflation risk and maybe a Federal Reserve that's still unwilling or unable to act aggressively, that means in real terms the opportunity cost of holding gold deteriorates, and that's pretty positive for gold. Of course, the risks are of much more aggressive increases in interest rates once you have an inflation problem down the road.
Thank you very much.
My pleasure.